The sixth stock I ever bought was 2,355 shares of TCT Logistics. This was a trucking company that had a fleet of refrigerated trucks. They were based out of Calgary. I was living in Windsor, Ontario, just across the border from Detroit. We were about 5 years into NAFTA. And anytime I drove anywhere, I had to cross a freeway that led from the heart of the American Midwest straight through to the main manufacturing centers in Canada. This was the busiest international crossing in the world. It might still be today. So every day I was exposed to trucks with logos from companies owned by TCT Logistics. It seemed to me that the volume of trucks only ever went up. I was sure this was a growth industry. The reason for buying 2,355 shares, I think I just divided the share price by how much cash I had in my account and went with that. I purchased them for 19.5 cents a share. With the $29 commission, it came to a total of $488.23. I knew these shares were just going to go up, up, up. It was June 16th, 1999. Today, we welcome to the podcast certified financial education instructor, Paris Cluff. All right, so it's good to meet you.
Thank you.
Paris Cluff, you went to Fresno City College, go Rams.
Hey.
Got an associate's degree in business admin.
Yeah.
Was the plan to get into business, get into finance?
Actually, it was. I met a guy when I was living in Florida for a little while, and he was international business, and he was dealing with all these really cool things, and he was showing me all this stuff, and I was like, I want to kind of do that. It would be fun to get into international business and travel, and just the glamour of it all kind of came to me. And when I moved back to California, I was kind of like slowing things down with education because I got married and my family and all that stuff was coming up. But I was at my job, and I was working for a corporation, and anybody who lives in California will know that Pacific Gas and Electric Company,
PG&E.
that's the provider of all electricity and gas.
Well, that's Aaron Brockovich too, isn't it?
Right? Yeah, the movie Aaron, yeah, for sure. And so I worked there, and the HR department came to me and said, like, "Hey, Paris, you've been working here long enough. You qualify for the 401k." And all I knew about money was that it was green and I wanted more, and I could barely spell 401k. Like, how do you even spell that? Like, what does 401k even mean? And so I started reading a lot of books about money, about finance, about like how to invest, because to me that was a pretty important thing. I asked some of my coworkers, like, "Hey, what is this 401k?" They're like, "We don't know, just flip a coin and throw darts and put it all in the company stock." And I was like, it doesn't sound like the greatest idea.
So they probably had a menu of options, right?
Yeah, for sure. Yeah, they did.
And was one of the options like, let's just plow it all back into PG&E?
Yeah, one of them. Well, yeah, absolutely. One of them was a PG&E stock. And so I was like, I don't think I want to do that. So I was like, okay, what I'll do is just figure out how to do it myself. I read a bunch of books. I figured out what I wanted to do. And then I had a coworker that was like, "Paris, I just qualified too. Can you help me figure it out?" And I was like, "Sure." And she's like, "Paris, you have a gift. You should do this for a living." Like, I finally understand what 401k means, what to do, and all that stuff. So I was like,
what were you reading? What kind of stuff did you read when you first
So I was reading things like Multiple Streams of Income by Robert Allen, read that guy named Rick Edelman put out a book, and I think I read Rich Dad, Poor Dad. I read Cash Flow Quadrant. And after that, it's like, well, maybe I should do finance instead. So I went back, I interviewed a buddy of mine who was a CPA and a couple other people that were in that finance world. And I said, what would you do differently if you could do it over again? And do you recommend this business for other people, like me? And in the process of doing that, I interviewed with a guy who was a recruiter for a broker dealer. And he's like, "Paris, why don't you do this? You can come work with us part-time and we'll train you, and you can earn while you learn, or you can go to school and you can learn and then earn." And I was like, I kind of like the earn while I learn aspect. So let's start there. And so I went out, they trained me, they taught me, I got my licenses.
This was insurance?
I have my life and health currently. I got my 6, 63, 65, and I let those go about 10 years ago. But I had them for 15 years. I was 663, 26, and 65. I had all those licenses for about 15 years and ran a branch and worked under the branch manager. I was the assistant branch manager for about, 10 or 15 registered reps. And so I have some supervisory experience as well as obviously just being a financial advisor myself.
Now, in those days, like, is this people coming in and they are looking to open a brokerage account with you guys, and then you were giving advice on where to invest their money? Or Was this like a sort of full package? You're doing insurance and
Yes, because I was licensed for everything, we did strategic planning. If somebody needed a 529 plan, of course, I offered that. What I would normally do for folks is I would bring them in, I'd take a look at their whole financial picture. I'd say, okay, you need some life insurance, you need some retirement planning. Sometimes we would combine those into like different infinite banking style products or services. Sometimes they're like, well, we just want to, fund money for our kids. So I do a 529 plan, or they say, Paris, I want an emergency fund. What's the best way to have an emergency fund? And back in those days, high yield savings accounts weren't as big deal as they are now. And so I just put them in like a real low volatility bond fund or something like that at Heimer, American Funds, something like that. No, not a recommendation, by the way. I'm not licensed.
yeah,
That's
yeah.
not a recommendation. I'm just giving history here. If somebody had an old 401k that they let their employer and they needed to roll it over, just help them with the rollovers and stuff of that nature. So just whatever anybody really needed with regards to their finances. And in the process of doing that, though, I found that most people really needed help with their everyday money. They needed help with their budgeting. They needed help, really what I call now a cash flow statement. They needed help understanding their income, their expenses, getting disciplined on their expenses. They needed to understand why they were doing things they're doing. I would spend a lot of time with people helping them to get to the point where I would show them how to free up money so that they could then buy the product I was hoping to sell them. And I felt like that was a little baity and switchy, if you will. And I was like, I'm not as comfortable with that as I used to be over the years. And so I was like, you know what? I want to just help people really understand how their habits, behaviors, and beliefs around money. And then if they're interested in investing, if they're interested in buying life insurance, of course, as the life insurance agent, I still offer that now, but I don't do the securities business. If somebody wants to do that, with all the fintech apps they have these days, it's like, if you want to do it yourself, go download Robinhood. But if somebody's like, I need help, I want to have a professional help me, I just refer those people out now to different professionals that are in the industry.
So at that time, most of the products you're selling, and when people are looking where they want to put their money for a 529 or something, was that mostly mutual funds you guys were looking at?
Yeah, so because I was 6 and 63, I didn't really have the ability to do individual stocks because those licenses only allowed me to do mutual funds, open-ended funds,
Yeah.
ETFs, things of that nature. I could do those. And so we spent a lot of time with the different companies that offered that: Transamerica, Oppenheimer, American Funds, Fidelity. There was just different ones, a bunch of different ones that I worked with and I used to be able to help people fund those goals.
Well, and that's like fairly common. Like you're talking about rolling up the 401ks because the Canadian system's a little different, but 401ks, if you leave your employer, then you can either leave it with your employer or you got to roll it over, right? And if you go to multiple employers, you could have a string of 401ks with a whole bunch of employers behind you, right?
Yeah, absolutely. And honestly, from the employee's perspective, you can leave it with your former employer. But from the employer's perspective, because I worked for a firm from 2015 to about 17, I worked for a firm that actually would go out and they would establish relationships with businesses and set up their 401ks or roll over their 401k, their whole 401k platform, because the company I worked with had really low fees. And so we would go in and find these 401ks and they were paying exorbitant fees, and we'd come over and take over the whole thing and roll it into a new 401k and give them a way better deal. Well, part of the process of doing the things we offered in that package was education to the employees. And so I would come in and I would educate the employees on how. So this is kind of a full circle story, going from I have no clue what a 401k is to now I'm the educator for this company, this firm, to help these employees understand what they're doing, how they're picking, and what's going on, what's available to them. And so what's interesting is that I got to have the perspective. Obviously, I had the perspective of the employee, but I really got the perspective of the employer and the actual plan and the plan sponsor and the fiduciaries. So that side of it, and they don't want to have those people on the books anymore. If you have an old 401k and they're running the numbers and they're looking at maybe they're getting audited by the IRS about how their 401k is working and their different rules around that. There's just things that they want to be able to clean up the books. So they actually honestly, they want people to roll their money away from it so that they don't have to keep track of it anymore. Their fiduciary responsibility is reduced because they don't have to worry about that guy or that ex-employee anymore. And so there's a lot of from the side of the employer, they would prefer that people roll their money away in most cases.
Okay, so when you first opened your 401k, I think you're with PG&E there, did they have good options? Was this all high fee stuff? Can you remember what you chose and how it looked?
No, I don't. I mean, that was 20. Oh goodness.
Yeah.
So I got employed there, 97. I was employed, and they had a 4-year window, vesting window. Actually, I think it was 3 years, but by the 4th year, you were fully vested if you stayed and you were able. So I probably, honestly, if I'm remembering correctly now, I probably had got my 401k when I was in 2000.
I don't know if that was good timing or not.
Right, for sure. Like the sky's falling, the world's ending, all the different things are happening. One of the things that was interesting is though, is that people are like, so the old adage, don't put all your eggs in one basket when it comes to investing. And somebody was like, well, we work for this company. Your health insurance is from this company. Your paycheck is
Yes.
from this company, and you want to put all your stock options and retirement plan in the company. I mean, okay, it's PG&E. So what are the likelihood it's regulated by the state of California? So is it going to go out of business? Maybe not, but that's too many eggs in one basket as far as I'm concerned.
Well, there's a lot of stories. I think Enron is a prime example where
Right?
there's a lot of people there that had all their stuff invested in stock, and in one day they lose their retirement savings, their health care, and their job. Yeah.
Yeah, and
It's
so I was like, I don't think I want to do that. So I mean, they're between ETFs, the standard index funds and the target date funds. I think though those were several of the options. There was balanced funds, there was conservative funds, preservation funds, bond portfolios. There was all kinds of international options, and I just know that there was some really good options. At that time, I wasn't as educated. After I left the job and I got my Series 65. I became a lot better at identifying where the fees were and the hidden fees and the 12B1 fees and all these other fees. I didn't really go back and look at it, but now if somebody was to show me, so I have clients that will show me their 401k, and I'll say, look, let's just go through and take a look at what the options are, and they'll show me their statements, or they'll open up their screen and they'll show me what's going on, and I'll say, click here, let's do this, let's figure this out, and I'll show them some things. I say, look, the company that you have, the best options, in my opinion. And because I'm not licensed anymore, I can't really give advice, quote unquote. So I have to give them my opinion. I say, in my opinion,
if it were me,
if it were
this is what
me,
I would do.
right, this is how I would invest those monies. And the reality is that there's some benefits to mutual funds and there's some benefits to ETFs. I feel like in general, there's a lot more benefits overall in ETFs because typically the fees are low. You can move them more quickly. They're way easier to liquidate or to move or to sell if you need to. Most of the time I recommend ETFs nowadays. There are some benefits to mutual funds that I think they're okay to kind of look at, but the reality is that most people, unfortunately, when they're dealing with their 401k, they just set it and forget it. And that's not good. You need to look at your 401k, in my opinion, at least every 6 months, if not annually, and make sure that you're doing what you need to do. One of the companies we represented, what was it called? They call it the Retirement Red Zone. It started with an A. They've been merged now. They're with another company now, and Prudential, I think, bought them. And anyways, they merged. But they were say the 5 years before you want to retire and the 5 years after you want to retire are some of the most critical timeframes. And you want to be as conservative as possible during those timeframes because you don't want to lose all your money right before you retire, and you don't want to lose all your money right after you retire. So you kind of want to be conservative through those 10-year window and have a more balanced portfolio so that you come out of it, you go into it with enough money, and then you come out of that phase with, hopefully with enough money now to make it last for the rest of your retirement. And so I would tell people, look, as you're 30 or 40, and if your goal is to retire at 65, you kind of want to be looking towards 60 as kind of a time to really hunker down and figure out what you want to do between 60 and 65, and then from 65 to 70. And so those are the things that I recommend is annually take a look at your investments portfolio. You look at your allocations and make sure that you're on track to what you really want to accomplish.
Okay, so I asked you earlier, we were emailing back and forth about what your worst investment was, and it sounds like maybe you had one or two there.
Mm-hmm.
So, well, let's talk about what you said. A real estate deal went bad on you. Let's talk about that first.
Oh yeah. So I don't know if you remember during 2007 and 6, 7, and 8, there was this huge, everybody was buying properties and flipping it, and they'd sell it for huge profits. And then, so I got involved in a syndication. Now I know it was a syndication. And a syndication is where it's like everybody pools their money together and they go in on a deal. And so it was kind of a syndication like that, where we went on some deals, some real estate deals. And this company that I worked with, they were buying and flipping houses. They'd buy them, they'd fix them up, and they'd sell them. And so I did it for probably 6 or 7 months, and I was getting my returns. It was coming back every 2 months. They promised a return every 2 months, and I got greedy, and I decided. So I basically got my money back after 4 or 5 months, and I was like, you know what? I'm gonna go take out a loan. And so I took out a loan, and I got like another 30 grand added onto what I was already doing. And I was like, I'm really going to make money, right? In like 4, 5, 6 months, I'll make that back and I'll be able to pay off my loan. And then the rest of it's liquid, it's cash for me. Well, literally,
bam, GFC.
Yeah, literally right as that last payment was coming. And I just roll it over because the more I rolled it over, the bigger it would get. So I didn't take it. I didn't take it out every month. I just let it roll over for those periods of time and let it stay with them. And during that period of time, it turns out that somebody, it was like kind of the middle of 2008, like and the company was like, we can't flip properties as fast as we thought we could. And they started taking new money coming in and paying that as if it was the profits to the old investors and hoping they could flip the property fast enough to make it look like it was a clean break. But somebody got caught wind of that at the SEC, or somebody got caught wind of it, and they're like, that's a Ponzi scheme. You can't use new investor money to pay off the old investors. And so they shut it down, and I basically lost it all. And I was like, are you kidding me? And then it was like 50 some odd plus. I had way too much money invested. And so, and then all of my clients at the time, a lot of my clients were like, hey, Paris, we want to invest our profits. We're going to go buy a house. We're going to fix it up and we're going to flip it. And then we're going to invest the profits. So they'd open up their accounts with me. They'd put money in it to kind of get it started. And then like, we're going to bring in bigger deposits after we flip our properties. Well, one by one, they're like, Paris, not only can we not flip the property, but we need the money we have with you to be able to continue to maintain the property because it's not selling and we're not liquid. And so I'm literally like, okay, here's how you withdraw. And I just watched all of my assets under management. All of my mutual fund clients are like, just one by one, just like, I'm cooked, you know? And so that whole era, that whole time frame just cooked me really bad. And I have a country music song I could probably write about that.
Sure. Well, I mean, I'm sure you're not alone in that point in time. Like, I think a lot of people got hurt pretty bad there. I mean, you're lucky you're still solvent, because I think there's a lot of people that suffered even worse. But
for sure. I would not wish that what I went through on anybody, but I'm grateful that I went through it because it taught me lots of lessons.
Well, that's it, right? Like, sometimes you learn more in the hard times and by the mistakes you make. Okay, so let's talk about that then. What you said another one was where you were chasing a dividend yield and then something got delisted on you.
Yeah.
Can we name names? Can we say what it was or no?
So I still have it in my portfolio, unfortunately, because it's been delisted still. But it was a mobile telecom communication company out of Russia, and they were paying.
What year are we talking?
This has got to be. It was right near the whole political issues around the Russian hoax and stuff like that. So
why did you decide to invest in Russian telecoms?
Because it had like a 10% yield. The dividend was huge, and the price of the stock was like, I don't know. Let me look it up right now. Actually, let me just bring it up. Because the price hasn't changed because they don't, it hasn't gone up or down since.
Yeah.
But the price of the stock was $5, and it was like a 10% yield. So I was like, let me just buy a bunch of this.
Yeah, sounds great.
It got delisted, and I was like, now I can't even sell it. You know what I mean? So I think I bought it. My average price is $8, $8.30, and it had a huge yield. And I was super excited about it. And then I recognized there was a couple other companies that I chased the yield, like some of the big yields are like 8, 9, 10% yields on the dividends. And I didn't do any good research on the actual financials of the company. I just saw the yield and I was like, buy. So I was like, bad mistake. So if you're out there looking at dividend stocks and you're chasing yield, please do yourself a favor and make sure that the profit and loss, all the rest of the stuff looks strong. And the company's going to give you some growth as well as good yield. So don't just chase the yield. That's my recommendation.
Yeah. I mean, why would you buy something at that time, man? Facebook wasn't paying a dividend. Why would you buy something like that? It doesn't even pay a dividend, right?
Right. Yeah, that's right. Well, the dividends were huge. And I was like, let's go. And then not good.
I have been there. Trust me, I have been there. What was your best then? What's your best investment then? And I don't know, are we allowed to talk about where this tip came from? Or is that like classic?
The Russian telecom tip?
No, not there. No. The
investment.
Rocket Labs. Did I give it away? I just gave it away.
Oh, yeah. So it's kind of funny because my son-in-law, he was dating my daughter, and he is a rocket scientist himself. He actually works for the space program. He works for Space Force. So it wasn't really necessarily an insider tip. It was just, he's into rockets and Elon Musk's and SpaceX and all these other things. And he's like, hey, Paris, because he knows I'm a financial guy. So that's kind of the one thing that we bonded over really quick. And so when my daughter was like, hey, do you like him? I'm like, yeah, of course. He loves financial stuff. So we're good,
Well, when you say my daughter's going to marry a rocket scientist, that's kind of cool, pretty good.
Yeah. So he showed me, he's like, bro, there's this company. They're up and coming. They're looking really good. Their stock is really, it's like, at the time he shared it with me, it was like $2 or $3 a share. I wasn't smart enough to buy in at that point. I bought in at like $5. Which was still decent, but the last time I checked, it was like 40 something bucks, $45.
Yeah.
And I bought a couple hundred shares at $5, and I'm like, this was this makes up for that Russian telecom thing that I did a little bit. You know what I mean? And so that was one of the best stocks that I did. I kind of have a redemption arc story with another investment I made, if you want to talk about that too. But that was the best investment that I made.
Oh, right. Yeah, no, that for when I asked you what your worst, you'd said it was a missed opportunity, right? Okay, yeah, let's talk about that one. What was
So
this one?
I got a tip. Of course, there's a lot of tips in the last 5, 6 years about SoFi, and they were a great company with student loan, and they had a great rates and great, just everything was really good. They were a strong company. And then all of a sudden, with the last administration, we had them pause all of the student loans. So nobody was
Student loan
refinancing
forgiveness.
anymore. So
Oh yeah.
SoFi, I bought SoFi because they were going to go into banking, and they had a charter that they were going to do. They had all this potential. They were getting into credit cards and other loans, and they were getting into actual, checking accounts, things like that, high yield savings accounts like they have today. And at the time, I'm like, dude, I'm going to buy a bunch of shares. I bought hundreds of shares of SoFi. And as I saw it go down and down and down, I was like, I need to buy 100 more to just get my dollar
Yeah,
cost average,
sure.
right? And
Yeah.
so I'm like, I need to get my average price down. And so I got I think the first 100 I bought were like $18. And then it was like 16. I bought another 100. It was like 12. And I'm like, I ended up with like, I eventually had like 1,000 shares of SoFi at like $6. And my average price was 11. And I'm like, I'm just like, what the, I'm not a swearing man, but I was tempted. And so I just was like, dude, you know what? As soon as it gets close to 10 or 11, I'm selling. I just got to get out from underneath this, because everybody's like, look, the worst thing you can do is hold on to a dying, it's something that's dying. Like, get out from underneath it. The whole adage, everybody was giving me the advice of like, look, dude, if it's not going up, it's probably just sell it. Get out, take the losses, get your tax, write off for the capital loss, and just invest in something else. So I actually was like, you know what? I kind of like the idea of SoFi though. So I'm going to just sell. I sold 900 shares. I got 100 shares left, and it's at $27 a share now. And I'm kicking myself. Like, I should not have sold. It's almost triple my average price. And I was like, if I'd have kept on to those other 900, I'd be sitting in a way different place right now.
Well, there's some kind of I don't know if it's an anchoring effect or what, but when it goes down and you've been suffering that long, you just think to yourself, once I just get even, I just need to get out. Like,
Right?
I'll be happy to be even. I'll be happy to be even because you're not in the hole anymore.
Exactly.
Because you had the confidence, right? You had the confidence in it to buy it all the way down.
Yeah.
And then it
It
just,
just stayed there for so long. And I kind of was in a position where I needed a little bit of tax write off. And so I was like,
yeah.
yeah, let's just, it kind of was, there was a couple of points that came to mind. There was like, you know what, let me just sell it. First of all, I was just tired of watching it go down and stay there. And then with that tiredness, I was like, I do need some extra write off. So let me just sell it for capital loss and run with it. But I kept 100 shares, and I've got those, and I'm looking at them right now. And maybe I'll do maybe I'll do some wheel strategy options trading and get myself, make a little bit of that money back.
Well, there's a lot of people are bullish on SoFi right now. So
I think so too.
yeah.
Now, yeah, now, hindsight's 2020, as they say, right?
That's right. Okay. So then what is your most recent, what's the last thing you bought?
Personally, I've kind of diversified into precious metals, and so I bought a lot of gold and silver recently, just
Really?
because I feel like there's some benefit to that as part of my portfolio. And so I have
Now, are you buying like coins?
physical gold. Yeah, physical
we
gold.
won't say your address or anything, but
Yeah, no, don't tell me. Yeah, and trust me, I'm a believer in the Second Amendment. So
yeah.
if you come to my house looking for metal, you might get the wrong metal.
Yeah, you'll get lead instead. But you're buying like coins, or are
Yeah,
you buying little?
yeah, I'll buy coins. I'm not really into the collecting so much
Yeah,
as I'm into just the raw bullion. And so
yeah.
I have been collecting raw bullion. I do. There's a new company that just in the last 6 years they created kind of a novelty, but that it's actually a functional way to use precious metals. It's called goldbacks. There's a lot of controversy about goldbacks because of the cost, but I think it's really cool as a functional unit of using precious metals in actual day-to-day trade. So typically you can't walk into a farmer's market or store and say, hey, I got an ounce of gold. What can I buy?
Yeah.
We don't trade that way anymore. We use fiat currency. We use currency for that, the dollar bills for that. But what this company did is they took gold and they fractionalized it down to the point where you could actually walk in and you could pay and buy stuff. They have a 1/1000th of an ounce denomination. They actually have a half of a 1/1000th of an ounce denomination, which right now, if you boil, look at the ounce right now and you boil that down to 1/1000th of an ounce, you're like, okay, that should be like what, 350 right now. Well, that's the raw materials, but the usage, there's a usage premium. There's a premium for the ability to have utilization of it easily. And so it's actually worth almost $7, even though if you boil down just the raw gold, it would only be 3, but because you can utilize it as a way of trade, it's actually trades it at a little higher. And that's true with any denomination of gold and silver. If you have if I have a 1 ounce coin, the premium on that is going to be less than if I have a 10th of an ounce coin. The premium is higher just because it's harder to you break that down. And same is true. So when you get it down into the 1/1000ths, and goldbacks are really cool and they're really beautiful. I love it so much. I became a dealer for them, and I actually can offer them as as an affiliate for that. So it's kind of fun to be able to teach people about it and say, hey, if you want to buy some, here's the link for it.
What is it actual, like, is it physical? Like you have a little card and there's a little piece of gold in it? Is that how this works?
Show you. I'll show you because you can see the camera, but the audio is not going to come through with the visual.
Yeah, that's okay.
It's actually what in the world of bullion, it's called an aurum, AURUM, and it's literally a bill of sorts. It's a
okay. So for people that are listening, so this looks like a dollar bill.
Yep.
And it's gold.
So they take
kind of got a plasticky feel, or what?
Yeah, it does. They take a film that's highly developed, a film, and then they 3D print the gold onto the film, and the film protects the gold and it protects the bill. But then there's beautiful artwork that's on it, so it makes it a little bit collectible.
Huh.
But it's also an opportunity to actually buy stuff. So there's a lot of businesses. If you go to goldbacks.com and you look at different businesses throughout the country that are accepting it, the last time I checked, there was almost 1,000 businesses across the country that take it and that will use it. And you can actually walk in and you can pay and buy goods and services with this. And it's a legal tender in several states.
So one of those bills is like, what's the value of that?
So this one is a 5. It's a 5. It has a 5 in the thing. Everybody's like, well, that's $5. No, it's 5/1000ths of an ounce. This is each 1/1000th of an ounce is roughly $7. So this right now is worth about $35.
And so with if the price of gold goes up, then in theory, that's worth more.
Exactly.
Right.
So what's cool about it, like, for example, one of the guys one of my buddies was telling me his air conditioning went out and he had somebody come out and look at it. And he's like, look, it's going to be this much money. He's like, what if I paid you in gold? Would you give me a discount? And the guy was like, yeah, sure. So he ended up getting a discount on the total price, paid in gold. And today, the guy because that was several years ago when it was like $4 per 1/1000th, now it's $7 per 1. That dude made a good deal. Even the guy who installed the new air conditioning made it a better choice because he now has more value in the gold because the gold tracks with inflation and it's a hedge against inflation. It's kind of cool to utilize that. I mean, when it comes to just traditional investing, though, I'll be honest with you, I've been a little bit more conservative with my investments, and I just been sticking to the typical indexes. So I just been funding my index funds for the last
like S&P 500 ETF or what?
Yeah, so I do VTI. Let me double check. I'm pretty sure it's VTI that I use, and then I have QQQ that I've been investing in, and I've been putting some money in. I don't know if you've ever heard of I don't know if you ever watched or read the book, The 3% Rule.
No,
so
who's that?
It's kind of an interesting book, and it's pretty cool. And what he talks about is have 70% to 80% of your money in an index fund, and then 20 to 30% in a bond fund. And then you just always maintain that balance. So as the index fund increases, you sell it off to fund the bond fund. You just keep that 80-20 balance with bonds and the index fund. And if the bonds grow, then you sell it off back to 20 and you buy into the index. And he says that the trigger is a 3% gain. So if the market is a 3% gain on the index fund, he sells it off and he buys the bond funds. If the bond fund has a 3% gain, they'll sell that off and transfer it over to the index fund. And so that's the strategy that I read about. And I was like, that's kind of a cool strategy. So I do my own version of it, but where I kind of maintain that balance. I didn't want to have just one index fund. That's what I'm getting at. I have a bond fund.
But these are Vanguards?
Yeah, I have so VTI and I have BND, which is Vanguard's total bond.
Right.
And so I have 20% in that, and I have 25 into QQQ and 55 into Vanguard total stock, VTI. So I have VTI.
Well, I mean, investing in the QQQs could have been doing well for the past 25 years.
Yeah, no. So right now, if I'm looking at my total gain all time, from just in VTI, I'm up 110% all time. And I think this is like just under 5 year window. QQQ is 106. Bond fund isn't done as well, but I'm up 12% in 5 years. So
Yeah.
I
Yeah.
do year to date. These will give me different numbers, of course, but just QQQ is 16 and a half almost just year to date. So I'm feeling really blessed with that. Basically, I'm just funding those right now. And I have a couple other ETFs, like some REITs and stuff that I like. But I also I really do enjoy dividend investing. And after I had a few mishaps with chasing yield, I did figure out a couple ETFs and individual stocks that I really enjoy. Like I have O, which is Realty Income.
Yeah, I got O. Yeah.
Yeah, I
Well,
like
because
O.
they're one of the kings, aristocrats, right?
Right?
Like
Yeah, they are.
they've increased their dividend. I don't know what it is, like 50 years,
Yeah,
something.
they've done really well. Of
Yeah.
course, in terms of growth, there's SCHD. There's and I'm probably not old enough for this, but I have it anyways because the yield is fun, and that's JEPI. JEPI is really an income fund. It's not a growth fund, and I recommend people who want to have growth. Maybe that's not the best one, but I like that one anyways. AMLP has actually been done really well for me in the last little while as well. So I don't know how many of these you want me to throw out, but
Well, no, that's fine. That's great. The thing about owning individual stocks is like you're probably better off buying the QQQ, honestly, but
right?
it's just not. It doesn't have the same. I don't know. There's some kind of itch that gets scratched when you're actually picking a stock.
Yeah, it's true.
And the whole dividend, like there's something about dividends too, like actually seeing that money come into your
Right?
account. There's just a different feel. And you
100%.
you look forward in time to when you stopped work maybe and you just cashing those dividend checks,
Right?
right?
Like every quarter, you're like, oh, dude, how much did I make? How much did I get?
Yeah.
Yes, totally. And O, of course, is monthly. Several of them are quarterly, and you stagger them properly. You can actually get paid every month. And so it's just, the other thing that I really kind of got into, and that's kind of what I was using SoFi for, was I wanted to get into options trading and I wanted to do the wheel strategy. And
Right. So I just interviewed a guy yesterday and he was talking a little bit about this, but can you just kind of describe what you mean by that for our listeners here?
Yeah, so there's covered calls. Covered call is when you have the stock and you sell a call option on that stock. So if you have 100 shares of a stock, you sell a call option. And usually if you go 1 to 2 weeks out, it's the faster turnarounds. The wheel strategy is the faster turnarounds. So if you have the stock already, 100 shares already, it's a covered call. If you want to buy a stock and you have the cash, it's called a cash secured put. And so the put actually is when you have the money already. My brain right now just said that I may have gotten that backwards. For those of you who are listening,
No, you got it right.
okay,
You
I
got
was
it
like,
right.
so the cash secured put allows you to buy a share. So my recommendation is, if you're going to buy a stock anyways, or it's a stock that you want to have in your portfolio anyways, why not buy it through a cash secured put position so that you make a premium? If you get it, and you got the premium and the stock at the price you put in there. So let's say a stock's trading at $50. And you're like, I want to buy it at 45. So you do a cash secure put to buy 100 shares at 45. If you get it, you get your shares at 45. If it drops to 42, you still have to pay 45. And you're like, bummer, but at least I got the premium. If it goes up to 60, you get it at 45. You won't get it because it'll close out. But
Yeah.
if you don't get it, then you
But
just
you
do it
collect
again.
the premium. Yeah.
But if you have money and you do a cash secure put and you get the 100 shares and you're okay with them, then what you do is you can either keep them or you can do a covered call. And the covered call then is the wheel strategy. So a cash secured put buys them, and then the covered call could sell them. And if you buy them, great. If you don't, great. You get the premium. You get to keep your money. If you buy it, if it ends up, if the put goes through, then you get to have the shares and you get to have your premium. And then you can just do the wheel strategy where you then do a covered call on it and you get the premium again. And if it sells, then you lose the shares and you just do the put again. If you don't sell the shares, then you get to keep it and do the covered call again the next week. And so the idea is that you want to do that with stocks that have a little bit of volatility. So I'm not as versed in that as I used to, because I did it for a while and I was having some success. And then again, I got greedy and I started to lose money. And I was like, you know what? I'm going to put this on hold for a little while. I'll come back to it.
So now what happened to you? You were selling a cash covered put, like you wrote a put, and then what? The stock just plummeted and you got stuck with it, or?
Yeah. So, and then I got stuck with it. And then I was trying to do the cash secured. I was trying to do the covered call, and I could never get it to be the price to make me even. Like it kept dropping so much that I was like, I have to wait now to sell this thing. And I'll be honest with you, it was mostly with SoFi. So that was the double whammy
Back to
for me
SoFi.
on that one.
Well, I know that's a very popular strategy right now. And like in a bull market, yeah, you're doing great.
Yeah.
If Tesla's going up, 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 you can just keep selling the puts and collecting premium.
Exactly.
And then, yeah, it's so volatile,
And
you get stuck with it.
it's
And
a
you
way
can
to
sell
kind
some
of make
calls.
your own dividend.
Yeah. Yeah. You just got to be careful. You can, like with anything, if
That's
there's a
why
reward, there's
to
also a
kind of
risk.
mitigate your risks, you want to make sure you're buying stocks that you would want to own anyways.
Right.
That way, if you do get to, if you are quote unquote stuck with it, you're at least stuck with a stock that you wouldn't mind having. So if you're going to do if you're going to do the wheel strategy, pick 4 or 5 stocks that you wouldn't mind having and holding on to in case you get stuck with them for a little while.
Well, and in the example you gave, if you're looking for something, it's trading at 50 and you write a $45 put on it. Well, if you were interested in buying it, you would have had to pay $50.
Right.
So
So you
if
get
you
a
get stuck
deal.
with it, hey, you got a better deal.
Yep. Yeah.
And it goes to 42. Well, you shouldn't be upset because you paid 45, but you would have paid 50.
Yeah. Yeah. That's
if you
true.
had bought it cash, right? So you right now,
I help people. What I realized over the years was that money has a lot more to do with habits, behaviors, and beliefs than it does with math. So I help people with their coaching and accountability. I'm more of an accountability coach around money, and I help people with strategies to help them maximize their cash flow. And that's basically, let's really dial in your expenses. Let's get clear on your expenses and your habits around spending, and kind of make sure that those are serving you. They're bringing you the value that you want in your life. We'll talk about different habits, ways to build habits, new habits. We'll talk about the old habits that you want to get rid of, and ways to kind of get rid of those and exchange them with new habits. And then we'll talk about like cash flow, like learn to live within your means and then grow your means. So we'll talk about what are some ideas that you have to increase your cash flow. Then we'll talk about your net worth, your assets, your liabilities. How can I help you increase your net worth more quickly, more strategically, and give you strategies and ideas that you probably never even heard of in most cases, or maybe you've heard of them and you're like, I just don't know if that's real or legit. I will give you the confidence to know whether it's legit or not, because I've probably done it with a client at some point in my life working with clients. And then I'll just share with you about how my goal with my clients is to get them away from the buy now, pay later mentality and get them into a save now, buy later mentality. And if we do that, we'll turn this whole thing on its ear with the consumerism, with the national debt, like all the stress and the problems around money. It really is from mismanagement of the spending side of money. It's not, and there's some that goes into income because we do need to make more money, but spending is really the kind of the bigger hole in our money management program. And so I teach people how to really manage their savings, strategic savings, and work on risk mitigation, reducing their risks for future. I mean, if there's anybody who should be preparing for Murphy and his laws, it's a financial planner. Like there's, my son, literally, he just texted right before the podcast. He texted me. He's like, Dad, my car, my tire is low. I think there's a leak. He walks into Costco because we bought it at Costco and they fix it for free. And they're like, yeah, you got a huge tear in this thing. $450 later, my son's walking out of Costco. You know what I mean? Like, he didn't expect that this morning, but he knows.
Yeah.
But because I've taught him how to save for those things and have a car fund and all those things, it's not as big of a hit to him because he's prepared for it. And so I teach people how to plan and prepare for those things in life. And then, of course, if they're like, hey, I want to start really building wealth, I want to start investing. I'm not an advisor anymore. So I say, I can't give you an advice, but I can give you, well, if I were you, my opinion, and if somebody's a DIYer, I'm like, hey, let's just download Robinhood and I'll show you some things. But if they're like, you know what, I really want some help, some advice, I have friends that still do it, and so I refer them over to my friends, and we have a network program like that. And then estate planning is a big thing. I want to help people figure out what financial freedom means to them. Like, let's define what is financial freedom. It's not just I want to be rich someday. But the common definition of financial freedom is I want to be able to do whatever I want, whenever I want, with whomever I want. So let's define that. Let's actually get that down and put it into numbers, or at least put it into words where it's actually a lot more clarity. And then let's figure out where you are, and let's chart a course to get you from where you are to where you want to be. And then I'm a coach, accountability coach, to help you and guide you and direct you on those, so to speak, turn by turn directions to get there. And so that's what I do now.
So if people that want to get a hold of you, these are people that maybe are struggling with debt, but also people that are looking to increase their net worth too.
Yeah,
they're just
for sure.
maybe they're starting to make some money and want to know what to do with it.
Amen. 100% right there. You nailed it. So like, there's a statistic that's running around that's like 60 to 70% of people who make 6 figures still feel like they're living paycheck to paycheck. I want to help change that. I want to help change that for you. If you're making six figures, you're making good money, you're married, you're arguing with your spouse all the time, you want to stop that. I jokingly tell people when they come on in my onboarding sessions, I'll say, look, if you hire me, one of the side effects is that you're going to have to figure out something else to fight about because you're not going to be able to fight about money as often. And so that's kind of a teasing thing, but I'm serious about it because I believe in marriages and I want to help save them if possible. And so I just help people turn their income into wealth. And I have a catchphrase that I say, I want to help you turn your income into wealth and build a massive bank account. Not a
The
literal massive
MBA.
bank account. Yeah, an
Yeah,
MBA.
the MBA. I
I want to
saw
help you
that.
get
Yeah.
your MBA, not that MBA. The MBA I'm talking about is a massive bank account.
And then you're a member of something called the National Financial Educators Council. I'm not familiar with that.
So there's a bunch of in the last, I don't know, maybe 20-ish years, 15 really, there's a financial coaching has kind of come out of the woodwork. And and I see people like, I want a financial advisor. What they really need actually is a financial coach. And because they're not managing their income properly, they're spending and they have no clue where their money's going. Their net worth is negative or barely over positive if they have a equity in their home at best. 90% of Americans have a positive net worth when they include their home. It's 30% if you take their home away. Most of America does not have a liquid net worth that's positive. And so I want to help with those things. Those are the things that I want to help with. Now, Paris, I want to start investing in stock market. That's great. But before you start investing in the stock market, you got to get your money right. Like you got to get your cash flow correct. You got to get your net worth down. You got to know where it's all going. Because what if you think I have $300 a month? Well, if we disciplined your spending, what if I could show you that you actually have $1,000 a month? I mean, how many more stocks? How many more retirement? What better rate of return? How many more dividend? Like, what would you do with that, right? How much faster could you hit your goal? And so that's what I do. I just help people get lean and I'm not talking about rice and beans. I'm not that. There's another famous
Dave Ramsey.
podcaster and radio show host that wants you to eat rice and beans. That's not my strategy. So I just want to help people really maximize and efficiently maximize their income and expenses so they can actually build wealth and have something to show for it. In 3 months, one of my clients, in 3 months, we were able to help them pay off about $10,000 in debt and increase their net worth by just around 20,000. Now, of course, the stock market had a little bit of help. I had a little bit of help with the stock market, but the paying off of the debt, that's all me helping them strategically coach how to do that. And their budget didn't change much. Like really. I mean, we leaned up some things and they got clear on some things that they wanted to keep doing. And but they were like, Paris, we can't believe we paid off that much money in that short a time. I'm like, do you see what happens when you get clear and you kind of have a goal and you're not tempted but to spend money because it doesn't fit within your goal? I just met with a couple this afternoon right before the call, and I said, look, when you know what your goals are, when you know what your plan is, when you know what you're building wealth for, you're not going to be tempted by every little purchase at Target to buy all these things. And so you're going to use that money more wisely because you need money for your mission. And I want to show you what your mission is and define your mission so that you're going to use your money for the mission that you have in your life and what you want to accomplish. And I'm not talking about like you're going to be a miser all your life. I build funds for fun and for spending and having a good time and going out on date nights and all those types of things. So it's all part of the planning. We can all be a little wiser with our money, even me.
Well, I think wrapping your head around the opportunity cost of if I buy this $100 item, what does that mean for, is that a day later I can retire? If I look in the long term, instead of just saying, oh, it's just $100 or it's just $10 here and there. I mean, yeah.
Well, yeah, I mean, there's always those stories where they're like, look, if you didn't buy that latte and put that $5 a day into the stock market, you'd have another $2 million by the time you retire. And while that's true, and why we should be cognizant of that, I don't think that means that we should never have have a drink that we can enjoy, or a little bit of ice cream or something here or there, or maybe buy dessert, or maybe instead of buying the top ramen at the restaurant, we actually buy a steak dinner instead. There's things that we should do to enjoy life as we're going. So it's not about the destination, it's about the journey and who you become on the journey. And so that's part of my whole coaching system, is that I want you to arrive at your destination as quickly and as efficiently as possible. But I also want to share with you ways that you can enjoy the journey while you're on your way.
Yeah. So again, not beans and rice, rice and beans.
Yeah, exactly. Yeah, that's true. That's funny.
Okay. And so if people want to get a hold of you, it's pariscluff.com. Is that right?
Yeah, they can go to my website. I'm on YouTube as well. I have a YouTube channel, Paris Cluff. You can look me up on YouTube. I'm on all social medias with pretty much the same handle.
Yeah.
But if you want to, if I can, I have a free ebook that I can offer.
Yep, right. I saw that. I saw that as well. And that's at your website as well, right?
Yeah, so it's pariscluff.com/free book. Basically, it's the process that I used for many years to help people find money in their current budget to really be able to create what I call as a positive cash flow. The average person frees up about $300 a month going through that program. I've had people free up 700, 800 dollars a month going through it. One of my buddies went through it. He freed up 600 a month. I've had others just do it, 50 to 100. But what could you do with an extra 300, 400, 500 a month? A month, you know what I mean? Not like one time, like a month. So the free ebook gives you the ability to do that, puts you in my system, and then I can reach out to you if you want to know more, or you can reach out to me if you want to engage in other stuff. So just the free ebook itself does those things. And then if I can reach out to you and coach you and do a little bit more, we can probably double that.
And now you also sell insurance in the Fresno area?
I'm licensed in 2 states, and I'd be happy to be licensed in any state of the great country of America. I do offer life insurance. If somebody wants to engage me as a coach, I separate it from my life insurance.
Yeah.
I do talk about life insurance and coaching in my coaching program. And if people buy life insurance from me, then I have a program where we can work something out for that. But if they want to buy it from their brother or their uncle or whoever's their agent that they already have, I'm like, all I care about is that you have what you need. And if you get it from me, great. If you get it from somebody else, that's the most important thing, is you get what you need. But if you do it with me, I have, opportunities for discounts and other things.
One last question, because I got to ask everybody this, and especially after seeing the gold paper, Bitcoin.
So in reality, I'm a little bit of a prepper. So I err on the side of tangible things for me, and Bitcoin is a little too electronic. I did have 5% of my portfolio many years ago in Bitcoin and other crypto.
Okay, we got to talk. What cost was that?
So it actually was funny because I bought 5% of my net worth into it was Bitcoin, Ethereum, it was Cardano, I think, and I did buy some Dogecoin.
Oh yeah,
everybody's got to have a little bit of Dogecoin in their past, I think, but I had probably 10 different coins in total, and it grew to like I bought 5% and then it went up to like 8 or 9% of my portfolio. And I was like, dude, this is the deal. This is great. And I'm just going to ride this thing out. And then it would drop down to like 3% of my portfolio. And I'm like, and then everybody's like, Bitcoin's going to be 500,000 by the end of the year. And after 3 or 4 years of telling me it's going to be 500,000 by the end of the year, I'm just like, you know what? Yeah. Even Kathy Woods, dude, I listen to Kathy Woods and I was like, she even says she's bullish on it. And she said it's going to be 500,000. It's not even 500,000 now, and it's been like 6 or 7 years since then. I mean, granted, it's fantastic price now, and I kind of do wish I would have kept it, but I'm like, you know what? I'm going to get out of Bitcoin, and that's why I went into precious metals, because I hold a significant portion of my net worth right now in precious metals, and so that's where I'm at, because I believe that, call me a wackadoo and a tinfoil hat wearer or whatever you want, but I do believe at some point that there's a real possibility of the grid going down. And if the grid goes down, all electronics are cooked.
Well, I mean, yeah, if I got my Bitcoin on my hard drive and there's a good EMP or something, I don't know.
Yeah.
I don't know how good that Bitcoin's going to be.
There's a ton of military leaders that have said over the years, it's not a matter of if, it's a matter of when, something like that can happen. So I'm just like, all right, you know what? Part of me is like, you know what, maybe I should get back into Bitcoin a little bit just to have it for the short term. But my wife's like, no, let's just buy more gold and silver. So I'm like, all right, let's do that.
Well, worst case scenario, you can at least make a nice necklace for your wife with the gold. But right? I mean, I don't know what you can do with the Bitcoin.
Yeah, exactly.
Well, this has been a great conversation. Is there anything else you think you want our listeners to know?
One of the big things that I feel like people should know is educate yourself. Make educated guesses, take risks, but make sure they're educated risks, because that's going to mitigate the risk. Don't be scared. We all make mistakes. We all lose money in the market. Don't be scared to do something because you're fearful. It absolutely blows my mind how many people that I talk to that are like, we have tens of thousands of dollars in a CD in a bank. What is it there for? Well, it's for our retirement. Like, no, get it in the market. I'm too scared to get into the market. That's because you didn't educate yourself and you haven't taken calculated risks. That's how you do it. So that's what I just suggest people get educated, get literate with your finances, learn, be educated, and just go and try it. Start with money that you can afford to lose, and then build your confidence, and then work your way up to the point where you're like, you know what, I think I can go and really do some good. And you'll find that in a very short period of time, you'll have a lot of confidence to really build wealth.
Great. Well, thanks, Paris, for joining us. It's been a fantastic conversation, and you've given us lots to think about, and I'm sure you've educated some of our listeners. Thank you very much.
Well, thanks for having me on, Terry. I appreciate it. Had a little fun and laughing with you. So it was good stuff. Thank you.
TCT Logistics, the company that I mentioned at the beginning of the episode, continued to grow along with the volume of trucks that I would see crossing the highway every day. To fuel this expansion, they took on enormous amounts of debt. As long as they continued to grow, this worked out for them. When trucking rates and volumes continued to climb, everything was fine. Then 9/11 happened. Instead of seeing trucks fly by on the highway, I saw lineups of trucks waiting to cross the border. Volume of international trade dropped precipitously, as did the trucking volumes for TCT Logistics. Following that, the revenues plummeted and they eventually went into insolvency. The shares were delisted in 2002, so my investment was now worth $0. It remained in my brokerage statement. Every time I looked online, I would see a nice big red mark. And it stayed there until 2011 for some reason when they were erased from my brokerage account. I liked having it there as a reminder to me to be more careful in the future. One lesson I think I took from the TCT Logistics debacle was to always be conscious of how much debt a company has and what that can do to the company. I think that's especially true now when interest rates are a little bit more volatile than they have been. Just some additions to that episode and maybe some fact checks. Paris mentioned a Rick Edelman book, but he couldn't think of the title. I think he's probably talking about The Truth About Money, which was huge in 1997. So it fits kind of the time frame he was talking about. But Rick Edelman has a ton of books out there. I can't recommend them necessarily. I haven't read that one, but it might be something worth checking out. He also talked about the retirement red zone. He couldn't think of the company. I think he's talking about American Scandia, which was later bought by Prudential. And just out of curiosity, I went and looked at the stock price of PG&E. If Paris had stuck all his 401k money in it in around 2000 to now, share price is still not recovered from where it was. With dividends, he might be about even if he had done that. So I think he made a good choice not putting it all in his PG&Es. Another book that Paris mentioned, I think he called it the 3% rule, but I think he just maybe misspoke. I believe he's talking about the 3% signal, which is by Jason Kelly. Again, that's not one I can recommend off the top of my head because I haven't read that one, but maybe another good place for you guys to look. And Paris did talk about his different licenses, the Series 6, 63, 65, and the 26. For those of you that maybe aren't familiar with the US system or just how the licensing works, financial representatives in the States are regulated by the Financial Industry Regulatory Authority, or FINRA, which you might hear often in the financial press. The Series 6 is a license you need in order to sell mutual funds, variable annuities, and life insurance. Series 63 is more of a state-specific one and ensures that you are familiar with state regulations. The Series 65 is a license that you need and an exam you have to pass in order to give investment advice. And the 26 is the license that you need if you're going to be supervising people who sell mutual funds. The other big one you'll hear people talk about is the Series 7 exam, and that's the one you need to write if you want to be able to sell stocks and bonds and options. Please remember that everything here on Terry Hogan Talks Stocks is for entertainment purposes only. This is not investment advice. You need to do your own due diligence. If you'd like to be a guest on Terry Hogan Talks Stocks and tell us about your first, your worst, your best, and your last investment, you can find me on Twitter or X at Terry M. Hogan. If you want to just send me an email or maybe an e-transfer because you like the show that much, I'm terrymhogan@gmail.com. And if you'd like to get a hold of our guest, Paris Cluff, you can find him at pariscluff.com. We'll leave you today with a quote from one of the great money managers of all time. That's Peter Lynch. And this is from his book, One Up on Wall Street. That's one I can recommend that I have read. Remember, things are never clear until it's too late.